Welcome to topic 9, costing and pricing. In this topic, we're going to look at how to define a cost object and how that cost information is used. We're going to be classifying costs into direct cost and indirect cost for individual cost objects, discussing the allocation process for indirect costs, calculating the full cost of a cost object, then working into calculating the inventoriable cost of a product, and finally, discuss some of the pricing issues for products and services. So to begin with, a cost is a resource and it is going to be measured in monetary terms. Now, obviously, there are you consider costs in many ways, but given this is an accounting course, financial monetary terms is a really useful way to think about it. And it's a cost which is also something which is used to achieve a particular objective. Now that is obviously going to be dependent on what the business is trying to achieve or what the organization is trying to achieve. So a cost object is basically anything for which a separate measurement of cost is desired. So this could be a product. So if if you have products that you sell, physical products, could be online products, whatever they happen to be, having an idea of the cost to provide them is going to be really important, as we obviously get later on in the section on the topic today. If you don't know how much it costs, then you could well misprice it. Now, obviously, pricing is going to be driven by factors other than cost, and that's going to be what the market is willing to bear. But knowing what the cost underlying the product is going to be something really important. It could be services that you provide. It could be, it could be attached to customers. So what is it to sort of maintain or manage those customer relationships? Business units, geographic regions. There's a whole different set of ways in which you could think about cost objects and how costs sort of get attached into them. And that attachment or assignment is really important. So costs need to be assigned to the specific cost object that caused the cost to be incurred. Now it's how we assign costs, and we can do it in a very simple way. And once we look at some of the examples later on, this can be done in a very simple, very easy to calculate method. But unfortunately, as with many things in life, simple is not always the best. And it's not just so that we can give accountants jobs. It's because there are going to be ramifications for doing that sort of internally within the organization. And this is much easier to be seen when we look at the example, when we attach some numbers to it, and we can see how this could sort of bear out in a real sense. Cost information, it's a system used by entities to collect and report. The costing system is a system which collates all this information. And obviously, it's very hard to do the allocation properly if you don't have the information in the first place. So you need to make sure that you're collecting all the required information that you need. And this sort of gets at that point, is that to be competitive and to be sustainable as a business, to have longevity in the business, you obviously need to be profitable. And to do that, you need to understand how costs flow through the system and that internal value chain. So what is, the R&D cost for creating the particular product, the design cost, how it's distributed or how it's produced and distributed, and how you manage it after the fact. So all of these costs are important because they're going to affect, how much margin you make on the product, how you price the product or the service. And again, this is what entities need to be aware of. So we're doing this, and we've sort of alluded to it, but the idea is that to allocate these costs, we need to know what sort of drives them. And so we need to first align costs to activities. And then once we've got activities, we can align them, we can then sort of set them to the object itself. So we need to know what activities are actually happening, and then the cost of, I suppose the cost of those activities, and then how much those activities are being used by a particular cost object. Again, the costing system is really important, so we understand how the costs flow through and what the actual full cost of a particular item, a particular cost object is. And that could well be a product. And maybe for ease of use, we'll think about it from a product point of view, but it doesn't just have to be products. So full cost is the direct cost. And so when we're thinking about direct costs, we're thinking about, direct inputs for labor. So the actual people involved in the manufacture of the product directly. We're thinking about direct materials, so the things which we can see directly going into that. So if you're making a phone, it could be the screen for the phone. So that's a direct material input into that particular product. All the various indirect costs might be associated, let's see, overhead costs. So it might be, electricity, for example. So electricity is used to run the machines, and those machines help create the products. We can't say that exact what went into making that particular phone, but we know electricity and the cost of it was involved in making those phones. So we need to allocate it in some way. And so direct costs, as already mentioned, can be directly traced to the object. And so that's a really easy thing to do. Okay, so really, it's the easy part of what we're looking at today. And so obviously understanding what those direct costs are and labor hours involved and labor into products and materials into products. But there's a direct tracing into there. Its indirect costs, as I mentioned, electricity is a good example. If you've got different products being created in the plant, you might have phones in one place, tablets in another, some of that, and computers in another part. That electricity, that indirect cost, is being used to create multiple different things. And we need to sort of allocate it across. We don't know particularly which, I would say piece of electricity, but what is going into product A or product B or product C, but we know it's being used somehow. So it's how we allocate it is going to be really important. So how we classify those as direct or indirect, it's not really the focus of what we're looking at here, but it's going to depend on the level of analysis we're looking at. So it's not always going to be that a particular thing will always be a direct cost. It might be indirect in another setting, and it could be indirect in one setting and then direct in a different one. But when we look at the end of this, total cost of a cost object is the direct costs plus those allocated indirect costs. Now, why do we need to do this? Why do we need to allocate them? And one, we've already talked about, it helps us determine and it calculates out the full cost of a specific cost object. And that's really important because that helps us understand kind of at least a floor for pricing if we want to at least make money, or the organization wants to make money. It helps to allocate the cost of shared services. There are going to be things which are born centrally, and they may be allocated and they may be used across the entire organization. So if you think from a university, learning management systems, these are used across the entire university. And so that cost would need to be borne by all the various different faculties. It helps encourage the use of central resources by business units. And this is, again, often a point where you will get efficiencies from doing so. And when I think about it, again, it's from my experience with this sort of stuff. But again, think back to, or think back to, or it could be sort of consider your current sort of situation. For us, my workplace, they try to say if we have to do large amounts of printing, which, as we go more and more online, and obviously right at the moment, very online, they're trying to discourage us to use the printers to print off large amounts of stuff and to use central resources to send print requests through to central printing services because they can do it much more cheaply than, the office photocopiers and printers, within the faculty. And so that saves money at an organizational level. It also helps, different parties to keep monitoring of costs, because if you're using something but not paying for it, you don't care as much about using it. So if everyone is being allocated these costs across and how you use it, you've got a bit more sort of skin in the game to keep an eye on things. And finally, to comply with external requirements and regulations. An example of that being is that for IFRS, for example, inventory costs include all the costs required to get that inventory in a state ready for use or ready for sale. So all those indirect costs need to be allocated into it. So we actually do need to do it from certain companies that have to comply with IFRS or US GAAP or whatever accounting standards they need, they would need to follow this. So cost drivers. So an indirect cost, is already noted, provides benefits to multiple cost objects. So that electricity helps make different items in the manufacturing plant. The cost driver provides that measure of activity that explains how the cost object's use of the indirect cost. So it could be something like uses of machines. Now, we haven't got too detailed at this point, but the more a machine on average uses, the more a particular product uses particular machines to make it, the more electricity it uses, the more expensive, the more the cost of the electricity it should bear. For example, cost drivers provide that link between indirect costs and cost objects. And so what we need is some sort of allocation base, and that allocation base is a variable used to allocate costs from a cost pool to a cost object. So we're starting to bring in some, all these different terms, and we're going to see an example. We're going to see a couple of different examples here, using some actual numbers and whatnot, and that will help solidify kind of what we're referring to, because even though this stuff in practice can get quite difficult, and there are colleagues of mine working on healthcare costing, and those sort of things can get incredibly convoluted. The idea underpinning it when we see it is actually not that difficult, but it's just how granular you want to go with it. So cost driver allocation criteria. So how do we actually figure out what drivers to use? Cause and effect. So that's choosing the variable that cause resources to be consumed. So if we're thinking about electricity and electricity powers machines, it would make sense that, that driver allocation would be using something to do with machine time. The more that the machine is used and turned on, the more electricity it uses. It makes sense, and I'm not an engineer. I'm just going to go with that seems logical and stick with that. The benefits received. So this identifies the outputs of the beneficiaries of the outputs of the cost object. So it might be that you allocate advertising costs based on the cost object's increase in income, because the idea is that advertising will increase sales. So that's a different way to do it. Another way is, as you can see, seems fairly ad hoc, is just select a method that appears somewhat reasonable and fair. The ability to bear those costs. And this is looking at it from a point of view of like, how much can you actually, or an organization or a product or whatever it happens to be, actually bear the cost of that allocation. And that could be done on some level of profit, that, more profitable products or more profitable groups wear more of that cost because they just can. Now, obviously with each and every one of these, and there's one more, there are positives and negatives around those allocations, and you can probably guess there are some there which probably make less sense than others. But again, everything has a reason to be used. And finally, behavioral. So selecting a cost driver to modify behavior. So if you use direct labor hours to allocate a cost into a product or into a unit, that would likely lead to a reduction in labor hours, because what you've effectively done is increase the hourly cost of labor just by making that arbitrary allocation in. So then rationally, if it's a department, might go, well, we're copying additional costs for using labor, so let's reduce the amount of labor hours. And so you're actually trying to change some underlying sort of behavior there. So volume drivers, and these, looking at driver types, so volume drivers relate to output volume. The assumption here is that the indirect costs are consumed by the cost object in relation to its use of the volume driver. So labor or machine hours or some sort of units of output. So again, that idea of volume. A consideration here is that if the indirect costs are caused by factors other than volume, then you might end up having an incorrect allocation, and that's going to lead to a level of cross-subsidization between cost objects. And that's going to be problematic because it means one product may be wearing too much of a cost than it should have as compared to another. And that's not getting at the truth of kind of what's going on. And then if you're not getting at the truth of the matter, you may well then be making incorrect decisions going forward. Turning now to resource drivers, these are factors that measure resource consumption by activities. And what it does is it then allows costs to be assigned to various activities. And once you have these activities, you can then assign the cost from these activities to the cost object. So you're sort of following that idea of cost is happening, some activity is creating that, and then you can then assign the cost through the activity to the cost object. We have an activity hierarchy, and that's just a framework to describe how overhead costs change with various activities. And you may have an example for a manufacturing firm, and what you're seeing there is we're expanding out from the unit level. So from each unit of production, so it might be just a single product to a batch of products to entire sort of family of products to the entire sort of manufacturing facility. And so different things will happen at different levels. Getting now into the nuts and bolts of it all, when we're looking to take a cost, an indirect cost, and get it in, basically allocate it to a cost object, we need to structure the cost allocation formula. We need to calculate the indirect cost rate, and then we need to allocate the indirect cost to the cost object. The indirect cost rate per unit of cost driver is calculated as the indirect cost to be allocated, so that is part of that cost pool, divided by the total cost driver usage. Now with this is all done generally before production, so it's you're creating what you expect that cost to be, that overhead sort of allocation rate. So these will often be done before you actually start producing, which will lead to some variances later on. And we'll talk about that very briefly later on in this video. But the idea is this is all kind of using what you expect to have happen. So it's not going to necessarily be perfect, but if you were to do it the other way around, it can lead to information being available kind of after the fact, which is not that useful. So to work through this, so we'll look through the steps here, and then we will move to actually seeing this in practice. So the first thing is we look at what the relevant cost objects are, the number and type of cost pools, and appropriate cost drivers. So we're looking at kind of what we're trying to get what the costs are, what drives them, and then what we need to allocate them into. We then need to determine the indirect cost rate for each cost pool, and that is just taking that overall cost pool. So it might be electricity price, or electricity cost, for example, and divided by the usage of machine hours. And then we allocate that indirect cost to the cost object. And so that's looking at how much that rate is from step 2 and multiplying it by the entities, or the cost object's usage of that particular cost driver. And finally, once you've done all of that, you can take all the direct costs and the indirect costs, and you end up with the full cost of whatever it is you're trying to organize. It could be a product, could be a service, could be a department, could be a branch or whatnot. So what we have here is some information, and this information is the same as in the text. So I'm not going to go through the entire question because I actually do a 2-step process with this. We're only going to look at the first step because it gives you the gist of what we're trying to achieve here. And ultimately what we're trying to achieve is taking this item here, or taking this amount, the $699,500, This is the total of the indirect costs, and the indirect costs are rent, electricity, and general administration. We want to take that $699,500 and apply it to finance or to the various departments. These are the cost objects that we're dealing with at this point: finance, personnel, computer services, home insurance, car insurance, life insurance. So we've got 6. Now, one way to do this would be, we've got rent, electricity, general administration. Rent, electricity, general administration is just to take each one and divide it by the number of cost objects we have here, which are 6. And we add them up. And what you can see is the following. We have 200,000, 200, 199, 500, 199, 500, 300, 300. We have allocated all of this indirect cost to these 6 objects, all equally. So each department gets $33,333 in rent. Each department gets $33,250 in electricity, and each one gets $50,000 in general administration. And you could say, well, that looks fair and reasonable. There's 6 of them. They all get an equal amount. Done, and we can kind of walk away from it. The problem with this is that when we take a harder look at what's going on, some departments have done well and some have done, well, not so well. So if we look at computer services, they've got 1,000 meters of floor space, which is double most and 5 times life insurance. So they've actually done pretty well with this rent charge. They're paying the same as everyone else, yet they're using double, if not substantially more. Life insurance have a reason to feel somewhat aggrieved because they're paying the same as everyone else, and yet they use substantially less floor space. And look, we don't know if this is all in different locations or if they're all in the same building. So let's just assume for ease of use that they're all in the same building. So there's no kind of differential in terms of the pricing per meters of floor space. Electricity, everyone's using the same except computer services, which use double the amount. Kind of makes sense. And so arguably you could say they would be quite happy with that situation because they're paying the same for electricity as everyone else, yet they use twice as much. When it comes to number of employees, personnel have the smallest number, and done that the wrong way. They should be fairly unhappy with that situation because they're paying $50,000 in general administration, and yet they've got half the number of employees of most of the divisions and substantially less than both home insurance and car insurance. So both of these departments should be feeling pretty happy about things. So when we look at this, it seems that computer, home insurance, and car insurance have done kind of well by this just equal distribution of, or equal allocation of costs. Personnel and life insurance, they would have arguments as to why this isn't particularly fair. And when you're dealing with internal office politics, departmental politics, I can't imagine that lasting. There would be cases being made that, why are we copying $10,000 per employee where, these guys are only copying $2,000. So, that doesn't seem fair and equitable. And on the face of it, it isn't. So a way we deal with this, I'll just get rid of all the colors. The way we deal with this is to work out, well, what is the cost per resource driver? So we work out the rate. And in this case, the rate is $200,000 of rent over floor space of 3,200. I don't know why I did that. Don't need to fix it. Electricity, 199,500 over 70,000 kilowatt hours. And general administration is 300,000 over 80 employees. So what we have is $62.50 in rent per meter being in indirect costs. The actual, we don't know what the direct costs are, but so $62.50 in indirect costs for rent are being allocated by floor space. For each kilowatt hour of usage, $2.85 is applied to that department. And for general administration, for every employee, $3,750 is applied for general administration. And so what we see, so remember, I'll just write up the 116,583. So we have a memory of what that was. So if we apply it this way, the rent is the floor space times the rate up here. The electricity is kilowatt hours. I didn't actually need to do what I did before then, times kilowatt hours. And general administration is the number of employees times the rate. And we'll take this down. And what we end up with is still 200,000, 199,500, 300,000. Still end up with the 699,500, but you can see all the totals are quite different. Finance, well, actually we'll look at the smallest. So personnel and life insurance have the smallest allocation, 78,500, whereas computer services have the largest at 157. They differ around that 116,583. Looking at computer services, for example, they have double the amount of floor space than personnel, and they're paying double the amount of rent in terms of the allocation of it. Same with electricity. They're paying $57,000 in electricity, whereas the others are paying $28,500. So we've allocated these out based on the usage of the cost driver. And it seems to be a more fair and equitable way to do it because it's based on actually the usage of these particular things. And so that's going to be important. So turning now to inventoriable product costs, and this holds much of the same idea, but we're dealing very much with products here. And this represents the cost of converting raw material into a finished product. And any costs incurred to support the entity's activities that are non-manufacturing in nature are treated as period costs and expensed in the accounting period. So you don't attach sales costs to the actual cost of the inventory. What you include in the inventory cost is all the things that it costs you to make the product, but not to sell the product. So selling costs are excluded from being included in the cost of inventory. And the type of costing system that's used is going to be influenced by kind of what's going on with the product range and processes. And if we break it down very roughly, process costing is where you've got large numbers of identical items in a continuous process. So, I think we had an example of Coca-Cola before. I mean, they have large numbers of the same products, sort of bottles of Coke or cans of Coke going through, and it's just a continuous process. Whereas with the job costing system, you're able to identify individual products or maybe batches. So cars, yes, there is a level of continuous process there. So there's a bit of sort of flux between these two, but you can more readily attach costs to something like a car than you can to a bottle of Coke. Now, if you're talking, extremely high-end cars with small production runs, then that's a much easier proposition again, in terms of to be a job costing system as opposed to a process costing system. What you're effectively trying to do is to say, like, how easy is it to take the costs included to make this thing and actually attach it to that particular vehicle or to that particular item. Much easier with, say, a Maserati than it is with a bottle of Coke. So for process costing, the indirect manufacturing costs and the direct material cost, we can kind of see them all going into the process. And so if you've got these large number of Coke bottles going through, we just work out, what those indirect manufacturing costs are, and they get allocated in a way that makes sense. And so that's inventoriable product cost per unit. If it's more of a job costing, the difference being is that you'll be able to identify the direct material and labor for each of the particular jobs. But then you're going to have this indirect layer which sits over the top, and you're going to have to allocate it somehow across those different jobs or types of products that we see there. And so you're going to have to figure out a way to allocate them out, which is what we're about to do here with two particular products, soaps and candles, with 30,000 units of soaps, 20,000 candles. So we've kind of got two different batches going through. The direct costs we've been able to identify in 613, 125 in soaps, and 276, 875 in candles. What we also know is, coming a bit closer, labor hours, a quarter of an hour on soaps, and an eighth of an hour. I should really know how many minutes is an eighth of an hour, but I don't off the top of my head, which is my bad. For candles, machine hours is 1 hour for soaps and 1 hour 50. 1 hour 50. That's not right. It's 1.5 hours. Having a terrible time with time, and Excel and me just don't seem to go together. We also have this information about the indirect costs. So there are two departments with indirect costs involved. So we've got indirect costs of 60,000, indirect costs of 62,500. Indirect costs here are driven by machine hours, over here labor hours, and there are 60,000 hours for A and 10,000 hours for these. So what we need to do here is to come up with the rate, and it's a nice easy calculation over here because we've got this pool of costs. So we've got this amount of costs that we're allocating, and we divide it by the number of hours, and it ends up at $1 per machine hour. Over here it is 62,500 over 10,000 labor hours, so it's $6.25. And I will make that stand out a bit. So that's how we're going to allocate these into here. So to do this, we have indirect labor, indirect machine. Indirect labor is number of units. Oops, we don't want to do that. Equals number of units multiplied by labor hours multiplied by the rate. And for machine hours, it is number of units times machine times the rate. And we do the same with candles, so it's a number of units times the labor hours times, what are we doing here, labor, the rate, and equals the number of units times the number of machine hours times the rate per machine hour. And what we end up with is total cost is direct plus labor plus machine. I'll tidy this up a little bit. So after tidying this up, we end up with total cost of 690,000 for soap, total cost of 322,500 for candles per unit. 690 divided by 30,000 gives you $23 per unit, and 322,500 divided by 20,000 gives you $16.13 per unit. And what we have then is the inventoriable product cost per unit, and that's what we use in terms of, from an accounting point of view, what it enter into the accounting system as that cost per unit. Now, because this was calculated using expected numbers, there's often going to be a difference between what we think is going to happen and what actually happens. Not usually. I mean, it's incredibly rare that the future will hold exactly as we expect it. And this means that there'll either be over-applied overhead or under-applied overhead. And if the variance is significant, then you would sort of split that variance out between cost of goods sold and the inventory accounts. Otherwise, it just gets written straight off to cost of goods sold. So if we look at this example again, included in this and we'll just look at soaps here, included in this $23 per unit is direct costs and indirect costs. And that, well, we could actually just go that minus that. So there's $20.44 of direct costs and $2.56 of indirect costs. Then that $2.56 is based on what we think is going to happen, and in terms of output and in terms of cost. So we may have this cost pool may not be 60,000. This driver number of hours used may not be 60,000 either. So it's going to lead to a change. It's going to affect what kind of happens up here. And that could mean that this is different. If too much has been applied, we end up with a too high an amount in terms of the total inventory cost, which means, we've over applied it. And if we've over applied it, when it comes to going through cost of goods sold, we've had too much cost going through cost of goods sold because we've over applied it. It also means what we've got in the inventory account may be too much as well. So it depends on kind of how much the difference is, and we don't go heavy into variance and how to deal with it, but just be aware that what we've calculated here is not based on actually what happened, it's based on what you expect is going to happen. So there's different ways to price products, but if you want to really boil it down, and obviously this is an accountant's view of the world, if you have a cost-based pricing strategy, is looking at, well, we worked out what cost is, and then we just apply some sort of markup to it that we feel that we want. We want a margin on whatever we're doing. It's simple in this once you've got cost in there, so you know what your cost is, and you've got a cost to mark up on. But you're not necessarily taking into account what's going on in the marketplace. You could use market-based pricing, and that is looking purely at what what's actually going on in the marketplace. It's going to be harder to get a price point perfect, especially if you're new in the market, or if the market's changing quite rapidly. But obviously gives you a better idea of what's going to go on with sort of sales volume and what is going to happen there in terms of what products to focus on. It's not necessarily taking into account costs, and this is where still it's useful to have an understanding of cost, because maybe the market expectation for your service is actually below cost, and you can't, or not for a long period of time anyway, you shouldn't be selling things for below cost. So some of the factors that go into pricing products or services: peak load pricing, there are a range of different things, but peak load pricing is one of them. And that's when you can charge differential prices based on the time of day. Or it could be, time of year, but, time of day is often one that gets used. So if you think about the Sydney Harbour Bridge, for example, they have different pricing for the bridge toll depending on the time that it is. And a lot of toll roads may have similar sorts of things because they're trying to move people out of the peak period and into surrounding periods, because it sort of evens the flow up a little bit. The same Sydney trains have slightly higher fees, train fares when you use it during peak times, although given everything that's going on at the moment, I can't imagine it's going to be that busy at peak for the foreseeable future. Price skimming, when a higher price is charged for a product or service when it is first introduced. This depends on what the product is. You see, innovative products, tech products charging a fair bit early on, and that may be to sort of drive that desire amongst others that can't get hold of it. And you'll see a lot of products sort of drop in price, in those sort of markets after a while. And that is to sort of get interest up in that particular product. penetration pricing. So it could be the kind of almost the opposite sort of view, which is when you set prices low or incredibly low, as in some cases, say for example Stan, where it was I think free for the first 3 months, and that's to drive market share. And it makes sense for products like your streaming services to do that, because often once you get used to a particular product, you will keep using it. More so, and especially so, I would guess, when you are paying by direct debit. So you're not even seeing the money going out each time. So it's a much easier thing to capture market share when somebody signs up to use it. It doesn't cost them anything to use it to start with, and they don't really notice as it's being used after that. And it's not enough of a price each month for people to pay that much attention to. Price discrimination. So we're talking, I mean, illegal practices, but you could argue that price discrimination does happen. Certainly, in a lot of business now, there is opacity in how prices are set. And I would regularly use the example of when you're sitting next to someone on a plane, and not going to be a common occurrence for the near term. I have no doubt you would have very little idea, unless it's someone you know, how much they paid for that seat. So there are going to be differences in terms of pricing, but there are obviously ways in which this is done, which is discriminatory in nature. Predatory pricing is the act of setting prices low to drive competitors out of the market, and then once there is no competitor, then rising prices again. And you could consider, and especially in this sort of day and age, that if you have a major media presence with deep pockets, then it's potentially much easier to drive smaller competitors out of the marketplace, because media is quite a contested space, and advertising revenues for existing media players are drying up. So if you're a much larger organization, you could potentially drive, set your prices low and drive competitors out because they just can't compete. And then once they're gone, it's just you left. Collusive pricing is when two or more organizations conspire to set prices above a competitive rate. And, there are examples abound of this sort of thing. In 2006, the federal court in Australia imposed close to $60 million in penalties against a number of airlines, including Qantas, BA, Japan Airlines, and Korean Airlines, in relation to the collusion of in relation to colluding to set fuel and security surcharges. So yeah, I mean, this stuff does happen. There's a whole range of examples where multiple organizations get together to set a price higher than expected. And the final one is dumping, and this is obviously written in Australian context. And so in this case, it's when an overseas organization or company sells things into Australia at prices below market value. And by doing so, it damages the ability of local producers to sell into the market. Now, you kind of, one hand, you think, well, that could be good because consumers get a better deal. But if it's, the problem with this is that it obviously hurts the local industry, and that's not something governments, especially at the moment, particularly want to have happen. And if you've been paying attention to the news, certainly in very recent times, there's potential claims that Australian-based organisations are doing this internationally. So this is something that is happens or allegedly happened all around the place. So it's something to be aware of. And so in summary, we looked at cost objects, both direct and indirect. We calculated calculation of full cost, looked at inventoriable product cost. We looked at different pricing methods, factors affecting pricing, as well as illegal pricing practices.